We are at of money. We are a day for a manifestation with the money magnet, Dr. Somnath Saha. Over the last 3 days, we have learned so much from the mindset about money to the investment strategies, and now he's going to be sharing. Today's session is going to be a mega finale, amazing conclusion to this superb session. So let's go. I can't wait to see what Dr. Somnath Saha has in store for all of us. Let's go. The stage is all yours.
Thank you. Thank you. Good evening to all. What did you learn till now? What are the things? All the cameras on? Yes. Nitin, everybody, cameras on. Yes. And what have you all learned till now? Let me know little bit basics of trading and what is it that was most interesting to you? I mean, what was one big thing which you never thought you knew about? No issues, Anshul, no problem. Just let me know which was something which was not known to you at all. Yes, one of them was swing trading. Yes. What else? Anything else which was completely new to you? Never work for money. Let your money work for you. Yes. Money should be multiplying while you are sleeping. That is how it should be. Fundamentals and technical analysis, candlesticks, yes. Actually, if you go deeper into it, there is a lot of things to learn. Today we will only be actually touching the tip of the iceberg. Tip of the iceberg we are touching. It can, I mean, we will go ahead maybe in later days, we can go more deeper. But at least what I wanted all of you was to be just aware that there is something like this and which will be useful for you. All right. So let us start with what we have learned till now, and let me see how to go ahead with it. Okay, so let me share my screen. Wait, just because there is something going on with my computer. One minute, let me fix it.
Hello, what happened suddenly, Dr. Somnath Saha? I think it must be a light issue. Yes, suddenly the session stopped. I think it's the Dr. Somnath Saha. He's here. Yes.
Something middle class people, middle class people in nowadays getting they are retiring rich. Didn't you hear about SIPs, isn't it? SIP is a systematic investment plan, isn't it? So if you invest just 5,000 rupees over 30 years time with a 12% returns, you get 1.5 crores. But if you keep it in the bank, you are not even getting 20 lakhs over this period. So stock market is like planting a mango tree. You will start small, water it regularly, invest small in it. Soon you will have a basket full of mangoes, isn't it? So that's how it is. I mean, the stock market is not only for rich people, middle class people also can earn a lot of money in that. And then you thought about that if you put money and you lose everything, do you put all your money in one stock? That is what many of us did mistake before without knowing. You should never put all the eggs in one basket, isn't it? We all know that. So smart investors will diversify their portfolio into different multiple companies, into multiple sectors. I mean, like there are so many different sectors. No, steel is a sector, FMCG is a sector, motor vehicles is a sector, electricity is a sector, green energy is a sector, oil and natural gas is a sector. So there are different varieties of sectors. So you diversify into the sectors and see what is the trending sector, and then based on that you take the shares into different type of sectors and mix and match and have a different set of stock that is called a portfolio. So you never will be losing. So that is the moral of the story is market is not a casino, right? It is a wealth machine, but only for those who use it wisely. Got it? So this is what we were having the myth around this market, and that's why we were not so interested in this. Today we are all sitting here taking a lot of interest only because there is some awareness coming, right? For me also, I am also a very late comer, but still at least there I durust hai, isn't it? So for others, at least you have started early, and you should be doing it sincerely and seriously. Okay. So let us go ahead. So let us know a little bit of what are options, because most of the market it is easy to understand stocks. Stocks means you are directly buying shares of the companies, that is stocks. But the actual fun is in knowing more about the options, right? So option is like if you say they are contracts. They are contracts which are when you buy options are like contracts which you are allowed to buy or sell stocks at a fixed price before a certain date, and this date is the called expiry date. So call option is you buy when you expect the stock to go up, and put options are the stocks which you buy when you expect the market to go down. This is in simple terms. I'm talking about very simple terms, but we will go a little deeper later on. For example, if you buy stocks of TCS, a call option which is costing 3,500, and you know that it is market is going up. So when the TCS rises to 3,600, you make a profit. But if it falls below what you bought it, then you lose money. So options are risky, but they offer high rewards. So always start, because you are new, then you have to start with a small investments. Okay. And what is an expiry? Expiry date is the contract date, the contract period. like most of the most of the stocks and most of the indexes, they all have contract period of monthly, one per month. The expiry is on every last Thursday of every month. And but Nifty has a Nifty 50 has a, that is an index which has a expiry on every Thursday, every week, Thursday, weekly expiry is there. So options contract has an expiry date, a date when it ends, right? This we will understand more like when we will, I will go ahead and tell you, because stocks will be expiring on Thursdays, and uh, we will see how option contract, say call options, you expect the stock to go up. And when you buy a call option, you think the stock price will rise. And when you will profit if the stock goes above your buying price. And put option is there. I mean, one is called call option and one is put option. Put option is like when you sell a stock at a fixed price before expiry, and then it is profitable when the market is going down. You buy a put option when you think the stock price will fall. That means market is going down, you bought at a price, and the cost of that, the price which you bought that put option, it will rise if the market goes down. All right. So both are instruments. They are like instruments of trading. One is for market going up, another one when the market goes down. So if you buy a put option, that means you are buying when the market is going down. You will profit if the stock goes below the selling price. All right. So let us understand it. Uh, why options are risky? Option trading is risky because it has a time which is attached to it. Time is very important because this has an expiry day. Expiry day means if you are not getting the profit within that day, particular on the expiry day, the value becomes zero. The contract which you bought, the contract price which you bought, it will become zero on the day of expiry. All options on the day of expiry, it becomes zero. I will show you how it goes down. I will show you in the actual option chain. So because one of the problem is time decay, options lose their value as the expiry day nears. The stock doesn't move. And the premium, anything which you buy is called buy for a premium, because if your predictions goes wrong, you lose that premium. And another thing is, if the market is volatile, means whatever you have thought that it will go in this direction, because the market is volatile, it suddenly goes ups and down. If it suddenly moves up and down, your plan goes haywire. Whatever you have thought, it doesn't stay as it is. And those are the days like election result day. Suddenly the demonetization order comes. Suddenly there is a war declared by some big country, and the war started. And suddenly there is a change in mood, gross change in the mood of people. The market becomes very highly volatile, and you will see the effect of that volatility on the market price. If such thing happens, you should be very careful. Uh, Beginners should always try to avoid getting into the market on such volatile days, especially when results are occurring, especially when there is some sudden natural calamity or some international predictions are going on, something like US election, for example. You don't know what this president will suddenly declare. So people will be a lot more worried whether he will be in a positive mood or a negative mood, whether it will affect us or not. But global market as such will affect our market also. So any major elections will create some flutter in our market also. So those are called volatility. So try to avoid getting into the market when the market is volatile. Okay. So the safe strategy is start with a small investment, do paper trading. I will show you what is paper trading and practice it. See how you feel about it. Start gaining some confidence in it. See how, because you can do paper trading in live market. Whatever you do in the paper trading, we are not using your own money, but it will affect, it will go according to the live market. So then you will know that what decision we took, whether it is going as per my plan, whether I am losing money or I am making profit, you will be able to see in the paper trading without putting your own money in that. It is just for practice sake. Okay. So that is what is called paper trading. And we will be able to practically do it in one of the live sessions, which we will take later on. Okay. But I will show you where it is done and actually how it happens, that we will see on a live trading day when the market is open. Okay. So let me just give you a simplified story about how it happens. The story of insurance company. This is what I told you in theory. If it is looking very confused, then let me tell you what a story about these two persons. They are the Ramesh and Suresh. Ramesh is bought a car, okay, and Suresh is the insurance fellow who is buying, who is selling the car insurance. So Ramesh just bought a brand new shiny this red colored car, and but he is worried what might happen if suddenly it gets into an accident, because he is a new driver, recently learned driving, but out of his fancy now he bought a car, but he is a little worried about it. If suddenly there is any accident, what will happen? How will I get it repaired? So he wants insurance to be done. Okay. So he has a friend called Suresh who works in the insurance business. So don't worry, Ramesh. Pay me a small amount every year, and if your car gets damaged, I will cover the repair cost. Right? This is what your insurance fellows will tell, isn't it? Everybody has a car. You all know that, right? Everybody has made some insurance in some day or in your life. So uh, so he buys this insurance policy, but pays a premium for it, right? Got it? Insurance will have a premium. Exactly, all options will have a premium. In the stock market also, this is like buying a put option. Buying a put option, that means it is protection against a falling price. Buying a put option means if the market falls, if I buy a put option with a premium, that means if the market falls, I will still win. Buying a call option is when the market goes up, you will win. But buying a put option means if the market falls, then only you will win. Correct? You got that idea? Buying put option means if it falls, then only you will win. So you are paying a premium means you are like buying a put option, which will protect you against a falling market. So Suresh, being a smart, he sells a smart seller. He sells this insurance policy to hundreds of people, so he knows the technique. Most of them will never have an accident, right? Most of them will never have an accident. So Suresh gets to keep the premium, isn't it? So the seller always gets the chance and benefit of keeping the premium because the accidents rarely happen, right? So buyer, just remember this basic terms. A buyer has to pay a premium. The seller will receive the premium. Buyer feels he is safe because if at all anything happens, the whole repair work will be done. Whatever loss means, whatever I lose, if at all I lose, is the premium which I paid. That much only. But the seller, if nothing happens, most of the thing nothing happens, he is always nicely keeping the premium with him. But the risk is if something happens, he has to pay a huge money. Even if it is rare, but he has to pay a big money for the entire cost of repair. Right? So you are getting the picture between these two. Option trading is like that. So if any accident happens, he has to pay for the repairs. This means sometimes only he will lose money, but most of the time he will win because accidents rarely happen. Correct? So in stock market, the person selling options is like the option seller. Means we call it option writer, but most of the time they only will earn money by keeping the premium. But sometimes they will lose money when the buyer will exercise the option. Means he has the right. Buyer, when he signs the contract, that means he has the right to claim it. Correct? A buyer has the right to claim at the time of expiry, and the seller has the obligation to fulfill that contract. You are getting the terms? Buyer has the right to claim because he had paid the premium. Buyer has the right to claim at the date of expiry. Seller at the date of expiry has the obligation to fulfill that claim because he had taken the premium and he had signed the contract. Both had signed the contract. So option buying and selling is like having a contract of insurance. Okay. So both have the chance to win, both have the chance to lose, but you have to be smart enough to understand when to buy and when to sell, when I should be a buyer and when I have to be a seller. Okay. So one day, Ramesh actually crashed his car, right? And luckily, since he has bought the insurance, Suresh now must pay for the repairs. So this is just like an option trading. When the market came down, because he had bought the put option, he is got profit, right? So Ramesh, now the being the option buyer was right, and he now will make money. He making money is like because he is not giving from his pocket for all the repairs. That means he made money, isn't it? Even though the car got damaged, otherwise he should have paid so much of money, isn't it? He would have had to pay it from his pocket. But now Suresh is paying for it. That means indirectly he made money, isn't it? Saving money is like making money. He saved money is like making money. So he won. When the market fell because he crashed, he won in this case. But rarely he will take a chance, isn't it? Even though if he supposing if he buys the put option and every time he goes and crashes, will he do that? He will not do that, no? Because he will not put his life at risk because it is not the car which get damaged. He may also get injured. So most of the time, the buyer will not be thinking that he will lose money. He will buy only thinking that he will win money. But the seller is very smart. Seller knows if nothing happens within this expiry date, anyway, I will keep the money. Right? So most of the time, the seller will be winning. Option sellers, although they have limited profit, what is their limited profit? Is only the premium. The premium only he is getting, isn't it? He is not getting anything more. The seller of the option will get only the premium money, correct? Getting this concept clear? The seller will get only the premium money, which he got from the, but if he has to pay, he has to pay huge amount. So the premium he collected is limited profit. Profit is fixed, limited profit, but loss can be huge for a seller. For a buyer, what he loses maximum is what he is paid the premium. That is his loss. Okay. Even if nothing happens throughout the year, what he lost is only the premium paid. But if something happens, he can get huge profit, isn't it? So his buyer has limited risk, but profit can be unlimited. Buyer, limited risk, profit unlimited. Seller, limited profit, but loss can be unlimited. Are you noting these points? Just not to get confused. Can you write down small, just this one sentence? Buyer, limited risk, unlimited profit. Buyer, limited risk, unlimited profit. Seller, limited profit, unlimited risk. Because you should not get confused with this. This is the basics. If you don't understand this basics, you will not be able to buy things now. Because once we are going to the next step of buying or making a strategy of what to do, you should have this idea, clear idea about this. Who is a buyer? Who is a seller? And now understand one important thing. Market can go in three directions, right? Market can go in three directions, either up or down or sideways. These are the three directions. Okay? Getting it? Market can go in three directions. Buyer always will be getting profit only when it goes in his direction. Buyer will get profit only when the market goes in his direction, in the direction which he thought will go. Right? If he is buying a call option, that means it has to go up. If he is buying a put option, it has to go down. Only if it goes in his direction, then only the buyer will get profit. Right? But the seller will get profit if nothing happens. Means if the market is sideways, if it is not going up and down, seller is sitting nicely. He will get all the benefit of the premium because the options has a expiry. If nothing happens within that expiry period, he is going to keep the money. Because every insurance, like for insurance, you pay it for 1 year, isn't it? You pay it, the contract period is 1 year. Similarly, the option contract periods, either it will be a weekly contract or a monthly contract. The contract period, if it gets over, the premium which the seller got, he is bound to keep it, isn't it? So, out of the three situations, if it goes opposite also, the seller gets profit. If it doesn't happen, anything goes sideways, the seller gets profit. Only if it goes according to the buyer's side, only then the buyer gets profit. So 1/3 chance of winning for buyer, 2/3 chance of winning is for the seller. Got the calculation? Easy or very difficult to understand? Easy, got it? So that means seller is the actual player in the market. Seller is the more intelligent player in the market. Although buyers, most of the retail people, most of us think that buyers are benefiting, buyers will get instant profit, buyers will get to see uh, magic lottery ticket. That's why people buy the tickets, isn't it? Lottery people, they are making crores of profit only by this tendency, because people are buying the ticket thinking that they will win. And what is the chance? Very little chance, isn't it, of winning? One in so many things, one in this, one in that. It is a huge gamble, isn't it? So buyers are most of the time gambling in that sense. But sellers are the smarter ones who are just keeping quiet. They will just smile. They will smile and keep quiet. And they know that most of the time market will not favor the person who is thinking that he is the smarter. Got the idea? So 2/3 chance of winning is for the seller, 1/3 chance is for the buyer. So buyer has to be very intelligent, because he has only 1/3 chance. He cannot gamble. He has to be very intelligent, learn, know, and take perfect decisions: how to enter, when to exit, why you should enter. Why, how, when, where. Everything he has to be very clear before buying. Because anyway, seller has 2/3 chance of winning. He will say, okay, come, take it, no problem. Anyway, you have to come in the market. I am there to sell it to you, right? So this is the basic picture in the market. You got the idea, isn't it? So insurance is like same as insurance. Buyer and seller in insurance. Options also have buyer and seller. Insurance has a contract period. Options also have a expiry date. Insurance people will pay a premium. Similarly, options also, buyer has to pay a premium. Like buying a lottery ticket, you are paying something money, no? That is the premium. For buying an insurance, you are paying some premium. And have you noticed these LIC fellows? Anybody has life insurance? Any of you all have life insurance? When that fellow sat before you, he took out a table, isn't it? And to see according to your age, and whether you are a smoker or whether you are an alcoholic, whether you are having blood pressure, whether you are having diabetes, whether you are too fat or too skinny, so many things he will check, and according to your status, he will check in the table, and which is most suitable for you, he will give it to you, isn't it? Similarly, we have option chain. We have that table is called option chain. I will show you the option chain today. And as per the age, you are given a particular premium, isn't it? As according to your age, you will be paying a premium, right? Same way, in the option chain, the main crux depends on what will be the cost of the premium, will depend on the strike price. That is called strike price. Are you all writing these points? Small words? Because these are all new to you, isn't it? Many things are new, isn't it? So that is called strike price. The depending on the strike price, the how far it is away from the strike price, the option in the option chain, it will the cost of the option chain will depend. The cost of the price of the option or the premium to be paid for that option will depend on how far it is from the strike price. Okay, got it? These terms. Now the idea behind this story is to tell you that it is similar to insurance. Okay. So seller is like a insurance company collecting small premiums regularly, but it can face big losses if a disaster strikes. But it is a rare thing. Correct? Got it? Clear? Can we go ahead? Okay. So let us go ahead and see what is the role of a buyer and the seller in the option chain. This option buyer is the holder and he will pay a premium, gets the right, but not an obligation to buy or sell. But the seller who receives the premium has to fulfill. That means he has an obligation to fulfill the contract if it is exercised. Means at the day of expiry, if it is reaches there and whatever may be the if the buyer is in the profit, he has to give it in the whatever he has buyer has made profit, the seller has to pay. Whatever the buyer has made profit, seller has to pay. And always remember, whoever somebody is making profit, the other person has to pay from his pocket. There is nothing free money in the market that somebody else or the broker will pay. Broker doesn't pay. Broker is only the one who is facilitating the contract. Broker is not paying. Broker only will take some commission from you for facilitating this contract business. But in the business, somebody is the buyer or seller, either of them will be paying each other. Correct? If the buyer wins, seller has to pay. If the seller wins, buyer has to pay. Got it clear? So broker is nobody who will pay you money. Got it? The buyer has unlimited profit potential, but limited loss. Because of this statement only, most of the buyers will jump into the market, because they think that buyer has unlimited profit, no? That is why most of the retailers are buyers. And seller has limited profit, but has unlimited risk. But the seller who is smarter knows that although my risk is high, but the chance of meeting an accident is very rare. So that's why I will be safer. Got it? So this is the difference in the market. So when we see the market, always understand the market is run by the sellers. We should see the option chain, we should see the market, we should see the stock market always from a seller's point of view. Because sellers are the one who are ruling the market. Sellers are the one who are manipulating the market. Sellers are the one who are big players. Now, why sellers are big players? Because in the market, the rule is just because the risk is high that you can land up into big loss. If you want to become a seller, this broker will ask a safety money from you. Whatever could be your maximum loss from that transaction, the broker will ask money from you. That means margin money it will ask from you. So that means until and unless you have a good amount of money, you cannot become a seller. That means you have to have a good bank balance to become a seller, because although it will not be used, but you have to give it in advance to the broker. Because suddenly if you lose, broker will not come and search for you. Where have you run away? Oh, you have lost money. Now, where will I get you? You can run away, no? So they will not give a chance for you to run away. They will take money from you from the very beginning. The moment you sign the contract, how much money you can lose, they will take from you beforehand only as a deposit. So seller has to have a big deposit before getting into the contract. But the buyer does not need a deposit. Buyer can instantly go and buy it. give a small premium and buy the stock. And he doesn't have to be worried about it, because that is the maximum amount he can lose. That premium which he has paid, that is the maximum amount he can lose. So he is not worried. So the broker will not ask extra money from him. So most of the retailers, like small players like us, no, who are retailers, not the big financial companies. Financial companies, most of them are sellers. They have huge money, so they will be are like sellers in the market. We are retailers, most of us are buyers because we have little money. And with little money, we will be mostly buying. Got the difference between retailers and the financial institutions? Institutions are mostly sellers, and because they have huge money, they can deposit that huge money and become sellers. And we, the retailers, are small players, so most of us will try to buy. And even if we try to sell, we will be very small, minuscule, percentage in this big market. In this huge market, retail sellers are a minuscule percentage. Most of them are big financial companies, FIIs, foreign investors, DIIs, domestic investors, institutional, FII means foreign institutional investors, DIIs, domestic institutional investors. Getting my point? They are the big players. They are the one who can manipulate the market. We are retailers, we are small players. We will try to buy little, maybe sell little, that's all. Very small players compared to the big institutions. But now, if you are smart enough, you have to think like big players. You have to think like what the sellers are planning. And if you can align your thought process according to the seller's mindset of big players, then you will be taking decisions according to their thought process. Getting my point? So learning stock market is to know how to align your thought process according to the big players. Got it? Are you getting some idea? This is basics.
Some only, sir.
Yeah,
थोड़ा
pardon me?
थोड़ा.
थोड़ा थोड़ा
Sorry,
ना?
sir. Yeah,
हाँ,
yeah,
थोड़ा
yeah.
थोड़ा कोई बात नहीं, but at least you should know these terms, because
Yes.
if you want to learn it in depth, unless and until you know what you need to learn, this is, I am telling you, only the tip of the iceberg. But if you don't know the tip of the iceberg, you will not know how much depth it is, isn't it? How deep it can be. But just to have some idea what market is and how things are working, uh, uh, don't be afraid of it. But just because you are listening to these terms and finding something all totally new concepts, don't be afraid. It is not rocket science. You can learn. I also, being a doctor, can learn these things at this age. Anybody can learn, isn't it? Right? Anybody can do it. So don't worry about it. But I just wanted to give these some basic ideas so that you have a clarity what has to be thought about, what has to be learned, what is actually happening in the market, right? So for this, I am telling you all these basic things. So you got it? So it is seller oriented market, and sellers are the smarter ones. And if you have to think in the market, you have to be thinking in the seller's point of view. Okay, so if you want to make profit, although seller has the chance of unlimited risk, but they will keep a deposit, and they will be keeping where to come out. They will know which is the correct time to be safe. They will play safe, so they will not lose more money. Buyer also, if at all they think that I am losing, most of the time he will lose, but he should understand what is the maximum loss I can take. So he should decide before entering, he should decide what is the maximum loss I can. If it touches that, you should come out. All right. So both buying and selling should have a stop loss. That means stop loss means this is where I will not go beyond this loss. Okay, got it? So this is how it is happening. Who is profitable most of the time? I've told you the seller is the one who is winning most of the time, because option buyers are like gamblers. They are dreaming of jackpots but losing most of the time. Option sellers are like casinos. You are owner of a casino, right? Making small but consistent profits and winning in the long run. They know that one or two of them will win jackpots. Even if one or two wins the jackpots, but there are so many people who are losing, isn't it? So anyway, they are making profit. Even if they give somebody a jackpot, still they will have enough money because they are owning the casinos. Got the idea how it happens? So if you want to be a steady earner, so you should own a casino, right? Better own a casino, right? Rather than buying a lottery ticket. Got it, clear? So this we will come regarding short selling, which we were talking before. We will go later. Let me just show you something else about the market. Today, let us go into the market and show you what is the market. Now this is I will show something, some basic about. Are you able to see this one page? This page?
So we can see a chart.
You can see the chart, yes. Now in this chart, there is a uptrend and there is a downtrend. Okay. This is the uptrend, right? Can you see it? This one going up is the uptrend. Okay. And this one going down is a downtrend. Okay. This is called the weekly chart of our Nifty, our index, national stock. This is our Nifty 50 index. And how we know this is a uptrend? The rule is, if you start from here, from down, if you see, there was one small high and there was one small low here. If you compare it, when the market is going up, it is creating a higher high. See, if you this compare with this high, this is a higher high, right? This one is a higher high. And if you compare with this low, this is also a low, but it is a higher low. Compared to this is a higher low, right? This is a low compared to this. Compared to this is a low. I will show you if you can understand by this way. See, from here to here, this went up, isn't it? Compared to this is a higher high. But this one, from here to here, this is a small low, right? From this to this low. This is a low, correct? Compared to this went up, came down. But even if this is a low, if compared to this, but if you compare with the original low, this is a higher low, right? Low, but it is higher low. Okay. Same way, again this goes up and this is a higher high. Compared to this high, this is again a higher high. If you compare with this one, this is a higher high, right? And again, if you see this, This came down, but this low is compared to this, it is a higher low. Got it? Compared to this one, this is a higher low. Again, from here, it goes up to here. Compared to this high, this is again a higher high, right? And now, again, if you compare this one to this, see, this is a, compared to this low, this is a higher low. So the rule is, this is called Dow theory, huh? Dow theory, D-O-W, Dow theory. The rule is, if you can see in a chart higher highs and higher lows, that means this is a uptrending market. If you see in a chart multiple higher highs and higher lows, if it is going like this market is called uptrending market. The theory is called Dow theory. Huh? See, now again, one more, from here it went up again. Okay, so another higher high. Up to this stage, all higher highs and higher lows. Higher high, higher low, higher high, higher low, higher high, higher low, higher high. Up to this, it is going up. Now the trend is changing. The language will change. The language will change. Now see if this one, compared to this low, this is a lower low. This is one low. This was the last low, right? This was the last low. Compared to this low, this is a lower low. The language changed. And in this market also, when it started changing also, but still, again it went up. Here it went up. But if you compare with this high, this is a lower high. This is a lower high. Compared to the previous high, this is a lower high. You understood? This one started with a lower low compared to the last low. This was a lower low. And then it went up, but it is still, it is lower high. If it had gone here, it would have maintained the trend. If supposing if it had gone here, it would have maintained that same trend. But it didn't go there. See, it didn't go there. It was only up to this. And if you compare with this high is, although it is a high, but it is a lower high than this. Again it came down. See, again it came down. This one also, you can see maybe a equal low. Even if it can be a lower low also. If this is the low, if the green candle low, and if this green candle low, it is still lower than this, right? So this is again another lower low. And again, it went a little up. It went a little up, but this high compared to this high is a lower high. Right? And again, when went it down, it is again a lower low. Compared to this low, another lower low. So the language completely changed. Now it is more of lower lows and lower highs, lower lows, lower highs. This is a downtrending market. So the Dow theory says, if a market shows higher highs and higher lows, it is an uptrending market. And if the trend is changing to lower lows and lower highs, again, it is called a downtrending market. Clear? Clear? So if you see a daily chart, see, you can see so much of changes. That was a weekly chart, so we could see like in a daily chart, it will be so much of up and down going on, right? And so many candles, because it is a daily chart. I mean, there are in a week, there are 7 such candles, or rather 5 such candles. So each week will be having 5 candles. That's why it will showing more candles, because that's a daily chart. But it will look like this. Got it? Uptrending market will have higher highs, higher lows, and downtrending market will have lower highs and lower lows. Clear? Clear? Okay. All right. So this is called the trend. Now we will understand what is the basis of when to enter and when to exit. We have to plan something. For planning, let us see what are the basic things which you can see in planning. So we will go back to our weekly thing. Okay. Now, if you remove all of them, now we will draw something which is called where the market goes and comes down. That is called a, a resistance. Market when it reaches a place where it is not able to go more than that, that is called a resistance. Okay. And market, when it rebounds back, if you see here, see, this is a place when it came down and it went up. See, it came down here and it started going up from here. Right? This is called a support. So there in a market, there will be multiple support. So this is another support. This is another support. Right? These are all supports. From where the market rebounds back, they are called supports. Support means if you have 2 or more candles supporting, if you can touch 2 or more candles here, they will form a support. See here, this previously here there was a rebound, and again here again it came. So if you join 2 candles here, base of 2 candles, they make a support. Here previously it was going up, again at this point it made a support, right? If you see here, see this is one base and this is another base touching. Most probably now, if this market will, even if it comes down, there is always a chance of rebound from here because it is a support line. Got it? This place also, there are multiple bases touching here. in this area, here also there is a chance that the market will rebound from here. See this? See here, so many candles here coming at this area, no? So this can create a good support. When it creates a good support here, that means if the market reaches up to this line, there is a chance of rebound. So that is how we will be thinking. Now the buyer will be sitting here, buyers will be sitting here ready for the rebound. And sellers who are selling it, they will be putting a stop loss here that now I was making money when the market was going down. I was making money when the market was going down, but there is always this support is here. Now there is chance of reversal. So we have to be very alert when such point comes. Getting some idea? Why we need to understand these trend lines? These are trend lines. Okay. Now these are called horizontal trend lines. And there are other trend lines also like this. See, this is another trend line this is making a parallel trend line. These are called lateral trend lines. See, this market was within these two trend lines. This upper line was creating a resistance and this lower line was creating a support. And the market was moving in between these two. This is called swing trade. If you are moving within these two trends, this is a swing trader. And momentum trader is taking chance of the market going totally up here. They are momentum traders. They will put here, they will think that anyway, even if it goes down a little bit, doesn't matter. Ultimately, it will go up here. So they are momentum traders. But swing traders, they do not wait for this going up to this because this is a long time. See, if it is a weekly thing, it is almost so many months. So many months had passed. So momentum trader will wait for the months. But swing traders will take short-term benefits, will take short-term within this is almost years. Huh? See, momentum trader waited for years to come to get this profit. They know it will anyway go up. But swing trader, they will take the profit up to here. They let it come. If it is coming down, they will change their hat. They become they will change the hat from from bullish. Oh, first important, these two terms you should understand. One is called bullish, another is bearish. The people who are thinking the market goes down, they are bearish. Market going down is bearish. Market going up is bullish. So changing hat means if you are bullish, you will buy in this here. When you are bearish, you change your hat and you make profit here. Then again you become bullish, you change your hat. So swing traders keeps on changing their hats. But a momentum trader will be a bullish here and will continuously wear that bullish hat till this point. Got it? So this is the basics of getting into the market and buying and selling. Okay. Now I will just show you something which is called option obstra, and you can on the day of when the market is on and say now the market is bearish. Okay. So this is Nifty. Now we have opened a option obstra, and we are trying to build our strategy. Okay, this is called builder. We have clicked on builder and we are trying to make a strategy, and now we are a bearish because market is going downwards. We will think of like we are bearish. Okay, so now we will click on bearish. So bearish will always try to earn money by buying a put, right? if you buy put, say for example, long means buying, short means selling. Okay, buying, long is buying and short is selling. So if you buy put, so this is a put, that means you are buying an option put, and 27th March is the expiry day, and you buy one lot, that is 75 shares, and how much profit you can make by buying a put? It is unlimited profit, but maximum loss you can make is 14,000 rupees. Okay, but if you don't want to be taking a lottery, it is always better to be on the safer side. So you have to make an adjustment where you will limit your losses. So in such cases, you should, these are the spread. Okay, this is called bearish market. And if you want to make profit, because it is bearish, if you click this bear put spread, bear put spread means you buy a put and then also buy a put which is costly, which is near to the strike price, and then sell a put which is a little cheaper. Sell means it is, if it goes against your plan, it will protect you. Suddenly the market goes up, it will protect you. So then that's why you are selling a put also. If you do that and then you buy this, so this is called a strategy. So here a strategy means, here the maximum profit is undefined and there is a maximum loss is limited, but the chance of making profit has gone up. You are making a chance of making profit is 43%. Okay, so this all you have to learn in details later on, but these are called strategies. When you make a strategy, and this is how you make profit. So the margin required means the amount required for you to buy this is 33,000 rupees, but you have unlimited chance of making profit here. Okay. Only on live market you will be able to get exact numbers, but today I'll just showing you how it is. Another way of buying, making a safety thing is, it is called bear call spread. So if you see, if you can buy when the market is uptrending, buying call is going along with it, isn't it? Or you can sell put, is the same thing. And in a downward market, selling call is going along the market. So if you sell this way, so this is bear put, and see here, sorry, I will reset it first. If you want to, if it is bearish and if you want to make a bear call spread, I'm just giving an overview. It needs a lot of planning. See, bear call spread, you're making profit is 62% profit. Although you will have a limited profit and limited loss, but the chance of making, probability of making a profit has gone to 62%. So that means you are seller oriented. Here you are seller oriented. So if you are seller oriented, the chances of getting a profit becomes higher. Because although you will see the margin required is higher also, but the credit, already you have credit of 9,000 rupees. Already it is in your profit. You already earned this credit. Because it is a seller oriented strategy, you already got 10,000 rupees in your pocket. And still you have a chance of winning 62%. Although you are paying 56,000 rupees, but you will get it back. Once the contract is done, this is only for margin. Margin means it is deposit kept by the broker. You will get it back. Once the contract is over, you will get it back. But the profit is, you are already made 10,000 rupees profit here. So by depositing on 55,000 rupees, your chances of earning 10,000 rupees is already here. Understood? So this is how we have to learn the strategy, but most of them, if it is a seller strategies, are more profitable. You may need a little more deposit, but it is more, just I will compare with you again, I will show you. This is the seller strategy. And again, if I go for the buyer strategy, this is bear put spread. I will show you again. This is what we were doing, bear put spread. See, this is a buyer strategy. Margin money is required. Money required is only 33,000. Less than that, your maximum profit looks like 11,000 you can reach, but you may not reach it. But the chances of profit has gone down, right? The chances of making profit has gone down, will reaching that. So this is how the market goes on, and this is, we will do paper trading. We will do this learn on a live trading day. Okay. So that's all for today. I hope you could understand some basic, because it is quite deep and a lot of things which needs to be learned. But understand that both the places, this is Sensible and Obstra. These are the two places where you can practice paper trading, both the places. But I will teach you this on a live market day. But ultimately, the thing which you have to understand is you have to start loving this subject. You don't have to fear it. If you fear, you will not learn anything. You start loving this subject, and once you start loving it, you will understand it. You will learn it much deeper. And I am always there with you in future also, to spend lot of time with you in future also. But it is just an overview that this is how things can happen, things can be done, and you can be a winner in this market. Okay. So thank you very much. This is enough for today, and hopefully we will meet again soon, because most of the days we have crossed our time limits, and I made Niranjan wake up till late night. So I take, I know every time I think that I will finish it early, but once we start, it is very difficult to stop at a certain stage. Thank you, Niranjan, for the opportunity you gave me.
Thank you,
And
thank you so much for giving us extra time, and it is super valuable. We can all agree that Dr. Somnath has been amazing, right? Yes, 3 cheers
Yes,
for Dr.
yes, yes.
Somnath.
Yay.
Oh, 3 cheers for Dr. Somnath. Thank you so much.
Thank you so
And
much, sir. Thank you.
thank
yes,
you.
arigato.
So
We will certainly be continuing. Well, how many of you would love to have Dr. Somnath again?
Yes, in a practical class this time.
Yes. So we will certainly be meeting once again. We'll certainly be continuing once again. As for the remaining classes, tomorrow is a holiday. It's Holi, so take a nice break, enjoy, celebrate, spend time with family. No sessions. We are also taking a vacation. So happy Holi to everyone.
happy Holi to you.
And happy
Happy
Holi.
Holi,
Happy
everyone.
Holi. Happy
Happy
Holi.
Happy
Holi.
Holika Dahan.
Yeah,
And
thank you so much for being with me, and we will meet again soon. All right.
certainly. On Saturday, we'll meet Saturday 11 a.m. We'll be having the next master class.
Yeah.
And also on the final week of this month, kill the
Uh,
noise. On the final week of this month, I'm also planning something very special. But details, it's best to keep some things under as a secret. We'll be sharing details about it very soon. But stay tuned. We have so much more exciting updates coming for you. Take care,
Thank you,
everyone,
thank you.
and thank you
Good
so
night.
much.
Take care. Bye-bye.
Thank you. Thank you. Good night.
Good night.
Happy Holi.